Imagine this. You're holding a single dollar bill. Crisp, green, familiar. You probably think it was printed by the government, stored in a vault, and carefully handed out like a rare treasure. That it's real in the way gold is real, or water, or time. But what if I told you that almost none of the money in the world exists as cash? That the dollars in your bank account, your savings, your paycheck, even your mortgage are not stacks of bills in a basement, but lines of code, promises, shadows of value, conjured by a system most of us have never seen? We've been taught money is scarce, limited, hard to get. That's why we trade years of our lives for it, why we lie awake worrying about it, why entire nations tremble when it vanishes. But here's the quiet truth. Money isn't mined from the earth or rationed by some cosmic ledger. It's created, deliberately, continuously, by design. And not just by governments, not just by presidents or treasuries, but by banks. Ordinary banks on your street corner every single time someone takes out a loan. This isn't conspiracy. It's accounting. It's policy. It's the hidden architecture of modern finance. And once you see it, you'll never look at your bank balance the same way again. Centuries ago, in the narrow alleys of London, goldsmiths didn't just craft jewelry. They became the first bankers. People would bring their gold for safekeeping, and the goldsmiths would hand them a receipt, a simple slip of paper, proof of deposit. But something strange happened. People started trading those receipts instead of hauling gold through muddy streets. Why carry 10 pounds of metal when a piece of paper could buy the same loaf of bread? Then came the twist. The goldsmiths noticed something. Not everyone came back for their gold at once, so they began issuing more receipts than they had gold in their vaults. Not out of greed at first, but out of convenience, out of opportunity. And just like that, money was no longer just metal. It became trust, a promise, a claim on something that might or might not be there. Fast forward to the 1700s. Nations saw the power in this idea. In 1913, the United States created the Federal Reserve, not as a government agency, but as a network of private banks with public oversight tasked with managing the nation's money supply. Not printing most of it, but steering how it grows, shrinks, and flows. Gold still backed the dollar for a while, but by 1971, even that last tether was cut. President Nixon closed the gold window. From then on, the dollar wasn't redeemable for anything physical. It was backed by faith, by the strength of the U.S. economy, by the belief that tomorrow would be worth more than today. That moment didn't destroy money. It liberated it and unleashed a system where money could be created, not by kings or mines, but by decisions, ledgers, and loans. Right now, as you watch this, a bank somewhere is creating money. Not by printing bills, not by calling the treasury, but by typing numbers into a screen and hitting approve. Here's how it works. Step by step, no jargon, just truth. You walk into a bank and ask for a loan, say to buy a car. The bank checks your credit, nods, and agrees to lend you $30,000. Now, watch closely. That $30,000 didn't come from someone else's savings account. It didn't sit in a vault waiting for you. The bank didn't give you money it already had. Instead, it opened a new entry in its digital ledger. Asset, your promise to repay your loan. Liability, the $30,000 now in your checking account. In that instant, poof, the money supply grew by $30,000. Created from nothing but your signature and the bank's balance sheet. This isn't theory. It's standard accounting under what's called fractional reserve banking. Though even that term is outdated because banks aren't really limited by reserves when making loans. The Bank of England confirmed this in a 2014 quarterly bulletin. Commercial banks create money when they extend credit. The Federal Reserve, the European Central Bank, they all say the same. Money isn't pushed into the economy from the top. It's pulled into existence from the bottom every time someone borrows. And that means the total amount of money in the world isn't fixed. It expands with confidence and shrinks with fear. When businesses borrow to hire, money grows. When families stop spending and pay down debt, money vanishes, literally erased from existence. So the next time you hear the government prints money, remember, most of it, over 95% in the US, was never printed at all. It was dreamed into being by a banker and a borrower like you. If commercial banks are the engines that create money, the Federal Reserve is the driver steering, accelerating, or slamming the brakes. But it doesn't control the car the way most people think. The Fed doesn't hand cash to banks and say, "Go lend this." It doesn't dictate how much your local bank can lend to a small business or a home buyer. Instead, it shapes the environment in which money is born, like a gardener tending soil, not planting every seed. Its most powerful tool, interest rates. Specifically, the federal funds rate, the rate banks charge each other to borrow reserves overnight. When the Fed lowers this rate, borrowing becomes cheaper. Banks lend more. People and businesses take on more debt. And with every new loan, new money appears. When the Fed raises rates, the opposite happens. Loans get expensive. Demand slows. Fewer loans mean less new money, and sometimes a slow drain as old debts get paid off. But there's another, more dramatic tool, quantitative easing. During the 2008 crisis, and again in 2020, the Fed didn't just tweak rates. It bought trillions of dollars in government bonds and mortgage-backed securities. Not with tax money, not with savings, but by crediting banks' reserve accounts with newly created digital dollars. This didn't put cash in your pocket, but it flooded the financial system with liquidity, pushed investors into stocks and housing, and kept credit flowing when the economy teetered on collapse. Critics called it printing money. Technically, it was creating bank reserves, electronic IOUs only banks can use. But the effect? Real, massive, and deeply controversial. Here's what the Fed can't do. It can't force banks to lend. It can't make households spend. In a deep downturn, even near zero rates might not spark new money creation. If no one wants to borrow, money stops growing, no matter what the Fed does. So the Fed isn't the puppet master. It's more like a conductor, guiding an orchestra of private banks, market psychology, and public trust. And if one instrument falls silent, the whole symphony falters. You've never signed a loan agreement with the Federal Reserve. You've never walked into a bank and asked for newly created money. And yet, this hidden system touches every corner of your life. That student loan you're paying off? It didn't come from a pile of taxpayer cash. It was conjured the moment you signed. And as you repay it, with interest, that money slowly disappears, erased from the economy, one payment at a time. Your rent keeps rising, not just because of greedy landlords, but because low interest rates made it cheap for investors to borrow billions and buy up homes, turning neighborhoods into portfolios. More borrowing, more money, chasing the same houses. Higher prices. Even your job depends on this cycle. When businesses can borrow easily, they expand, hire, innovate. When credit tightens, they freeze hiring, cut staff, delay dreams. The health of the job market isn't just about skill or effort. It's tied to how freely money is being created or destroyed. And what about savings? In a world where money is born from debt, holding cash is a quiet act of loss. Because while your dollars sit still, new money floods the system, pushing up prices. Inflation isn't just rising costs, it's the dilution of existing money by newly created supply, unless wages and assets keep pace. This system rewards those who can borrow wisely, buy homes, start companies, invest early. But it punishes those locked out of credit or crushed by high-interest debt. The gap between rich and poor isn't just about income. It's about who gets to ride the wave of new money and who drowns beneath it. Your dreams of a home, a business, security in old age are not just personal goals. They're economic variables in a machine that runs on trust, debt, and digital entries. And whether that machine lifts you up or leaves you behind depends on rules most never see, but all must live by. This whole system, elegant, powerful, invisible, rests on one fragile thing: trust. Trust that loans will be repaid. Trust that banks won't collapse. Trust that tomorrow's money will still buy something. But trust can vanish in an instant. In 2008, it did. Banks had created trillions in mortgage-backed loans, money built on the promise that home prices would keep rising. Then, they didn't. Borrowers defaulted. The value of those loans evaporated. And because those loans were the money supply, the money itself began to shrink. Banks stopped lending, not because they ran out of cash, but because they feared each other. No new loans meant no new money. Businesses couldn't pay suppliers. Workers lost jobs. Spending froze. It wasn't just a crash. It was the silent implosion of the money supply itself. The Fed stepped in, not with speeches, but with unprecedented action. It slashed rates to near zero. It bought toxic assets no one else would touch. It promised unlimited liquidity, not to enrich banks, but to stop the bleeding of money from the real economy. And it worked, barely. But the scars remain. Millions lost homes, careers derailed, trust eroded. And a new fear took root. What if it happens again? Because it can. Every boom plants the seeds of its own bust. Easy money fuels speculation, whether in housing, tech stocks, or crypto. Debt piles up. Risk hides in plain sight. And when confidence snaps, the reverse alchemy begins. Money turns back into nothing. History shows this isn't rare. From the tulip mania of the 1600s to the dot-com bubble to the global financial crisis, the pattern repeats. Creation, euphoria, overreach, collapse. The system isn't broken. It's designed to expand. But it has no built-in brake for human greed or collective panic. And that's the paradox. The same mechanism that builds hospitals, powers startups, and puts food on tables can, in a moment of doubt, vanish like mist, taking livelihoods with it. Not because the factory stopped working, but because the invisible web of promises unraveled. For centuries, we've accepted this system as natural, as inevitable as gravity. But money isn't a law of physics, it's a human invention. And like any invention, it can be redesigned. What if money wasn't born from debt? What if every citizen received a basic stream of newly created money, directly, without borrowing, without banks, without conditions? That's the idea behind sovereign money or helicopter money. The central bank creates digital currency and distributes it to people, not financial markets. No loan, no interest, just a public dividend of the nation's monetary power. Some countries are already testing alternatives. In 2021, the Bahamas launched the sand dollar, a central bank digital currency, or CBDC, giving citizens direct access to sovereign money on their phones. China's digital yuan now reaches hundreds of millions. Even the European Central Bank and the US Fed are exploring digital versions of cash money that exists outside the commercial banking system entirely. Then there's the deeper question: should private banks have the power to create the public's money supply? In the 1930s, economists like Irving Fisher proposed the Chicago Plan ban banks from creating money, restrict them to intermediating existing funds, and let only the state issue new money. It was never adopted, but after the 2008 crisis, the IMF revisited it and found it could make the financial system dramatically more stable. And what about sustainability? Today, money grows when we extract, build, consume. But what if new money flowed only toward renewable energy, regenerative agriculture, or care work? A green monetary policy, where the central bank favors loans that heal the planet, not just inflate asset bubbles. None of this is fantasy. It's already being debated in parliaments, central banks, and town halls, because the truth is, we're not stuck with the system we have. We chose it, piece by piece, crisis by crisis, and we can choose again. Money doesn't have to be a weapon of inequality or a trigger for collapse. It could be a tool for resilience, for inclusion, for life itself. The technology exists. The ideas exist. All that's missing is the collective will to imagine a different kind of value. And maybe, just maybe, to build it.